Have you ever thought about your investment portfolio like it's a recipe? Maybe a carefully constructed salad or like a hearty, well-seasoned soup.
It's an interesting way to think about it.
It might sound a little odd,
Yeah,
but it's actually a pretty helpful way to think about different approaches to managing your investments.
it is.
And today we're going to be adding a unique spice to the mix, long volatility.
It helps illustrate the shift from traditional portfolio construction,
Okay.
what I might call the salad approach.
Okay.
Think of your typical 60-40 stock and bond split.
Right.
Everything's neatly separated, and to add a new ingredient, you have to take something else out.
Right. So it's all about maintaining those fixed proportions.
Exactly.
But what about the soup portfolio? What makes it different?
With a soup portfolio, you're not as restricted.
Okay.
It's about blending ingredients, using things like leverage and derivatives to create a more integrated, dynamic approach.
Okay.
It can get a bit complex, but the idea is to potentially boost returns while still managing risk effectively.
Now, I'll admit, the term long volatility still sounds a bit mysterious to me.
Sure.
Is it as simple as betting that the market will get more volatile?
It's a common misconception, but it's not about trying to time the market.
Okay.
Think of it more like buying insurance for your portfolio.
Okay.
You're not hoping for a disaster, but you want to be prepared if one happens.
Right.
And this insurance can actually help you benefit when volatility spikes.
Okay, so we're not talking about like crystal balls and market predictions here.
Yeah.
We're talking about strategic risk management.
Exactly.
Oh, okay.
And what's really fascinating is that long volatility, when used correctly, can actually do more than just protect you.
Wait.
It might actually enhance your returns.
Wait, really? That sounds counterintuitive.
It is.
How does that work?
Well, today we're diving into some research from One River Asset Management.
Okay.
They've done some really insightful work on this topic,
Great.
breaking down how long volatility, correlation, and the magic of compounding all work together.
Compound. Now, that's a topic everyone loves to hear about.
It's like the gift that keeps on giving, right?
Right. Yeah.
Small gains building upon themselves over time to create significant growth.
Yeah.
But the key is to avoid big losses that can wipe out those gains,
Right.
which is where long volatility comes in.
So it's not just about how much you earn,
Right.
but also about protecting what you've already earned.
Precisely.
Got it.
And One River found some pretty compelling results.
Okay.
In one study, they showed that a portfolio with a long volatility strategy actually outperformed a traditional portfolio
Wow.
by a significant margin over a 17-year period.
Okay.
We're talking about a difference of almost 4 times the ending value.
Wow, that's a huge difference.
It is.
And you're saying long volatility played a key role in that outperformance.
Absolutely.
Right.
And there are a few key ingredients that contribute to this success.
Okay.
Minimizing those big losses, using capital efficiently, and getting the rebalancing strategy right.
Okay, rebalancing.
Mm-hmm.
That sounds important, but to be honest, it's not the most exciting topic.
Right?
Why should our listeners care about this?
It's actually more crucial than you might think.
Okay.
Knowing when to take profits from your long volatility position can make or break your strategy.
Yeah.
It's the difference between simply weathering the storm and actually capitalizing on the volatility.
So it's like knowing when to hold them and when to fold them,
Exactly.
but in the world of investing.
Exactly.
All
And
right.
this is where things can get a bit tricky.
Okay.
Do you sell your insurance as soon as the market takes a dip? Or do you hold on, hoping for even bigger gains?
That's a tough call. It seems like there's a lot of potential for second-guessing yourself, especially when emotions run high,
Absolutely.
right?
And that's why One River dug deep into different rebalancing approaches,
Okay.
trying to find the best way to navigate these decisions.
Well, I'm definitely curious to hear what they found.
Sure.
What are some of the strategies they looked at?
They studied a few different approaches, and each has its own pros and cons.
Okay.
For example, there's calendar-based rebalancing, which basically means sticking to a regular schedule.
So kind of like setting it and forgetting it,
Exactly.
but for your long volatility positions.
Exactly.
Hello.
And this can be helpful because it takes some of the emotion out of the decision-making process.
Yeah.
You're not constantly reacting to market swings, which can lead to impulsive decisions.
That makes sense.
Yeah,
So you're taking a more disciplined approach.
exactly.
But wouldn't you miss out on some potential gains if you just stick to a rigid schedule?
That's the trade-off.
Okay.
You're sacrificing some potential for outsized gains in exchange for more consistent, predictable outcomes.
Right.
And that's actually what One River found.
Okay.
The research showed that calendar-based rebalancing generally led to more stable returns,
Okay.
regardless of the market's specific ups and downs.
Okay, so consistency is the key advantage there. But what about other approaches? Did they look at anything more reactive?
They did. They also studied threshold-based rebalancing,
Okay.
which is all about responding to specific triggers in the market.
Okay.
So instead of rebalancing on a set schedule, you're making adjustments based on how much the market has moved or how much your long volatility position has gained or lost.
So it's a more dynamic approach, trying to capture those big swings in volatility.
Exactly.
I imagine this would require a lot more attention and active management, though.
Definitely.
Okay.
And while it might seem like the path to those home run returns, it comes with its own set of challenges.
Okay.
One River found that this approach was much more sensitive to the specific path the market took.
Right.
You could end up with wildly different results depending on when and how those volatility spikes occurred.
It sounds like this approach is a bit more of a gamble, then.
It can be, yeah.
More potential for big wins,
Yeah.
but also more potential for things to go wrong.
That's a good way to put it. It's not for the faint of heart, and it definitely requires a deeper understanding of how long volatility works and how to manage the risks.
So we've got the steady and predictable calendar-based approach
Right.
and the more volatile, potentially higher reward threshold-based approach.
Exactly.
I'm guessing they didn't stop there, though, right?
You know those researchers
Yeah.
always looking for ways to optimize?
Right.
They also explored a hybrid approach,
Okay.
combining elements of both calendar and threshold rebalancing.
Interesting. So trying to get the best of both worlds.
Exactly.
Okay.
And their findings were quite interesting.
Well, before we dive into that, let's take a quick pause and recap what we've learned so far.
Sure.
We're talking about long volatility as a potential secret ingredient for boosting portfolio returns.
Right.
And we've explored the importance of rebalancing as a way to manage risk and maximize gains.
It's a crucial piece of the puzzle.
Yeah.
And it highlights the fact that simply buying long volatility isn't enough. You need a solid plan for when to take profits and how to adjust your position over time.
Right. So it's not a set it and forget it kind of strategy.
Right.
But with so many different approaches to rebalancing, it can be hard to know where to start.
Absolutely.
Right.
And that's where understanding your own risk tolerance and investment style becomes essential.
Okay.
Think about how much volatility you're comfortable with
Right.
and whether you prefer a more hands-on or hands-off approach.
Right.
And-
Okay, so we've covered the when of rebalancing.
That's right.
But what about the how much?
Yeah.
Does the amount of long volatility you use depend on your overall investment approach?
That's a great question.
Yeah.
And it brings us back to our soup and salad analogy.
Okay.
Remember, a traditional salad portfolio has those distinct allocations.
Right.
Stocks, bonds, maybe a dash of real estate.
Yeah.
It's simple, easy to understand,
Right.
but it might limit your flexibility.
And I'm guessing that flexibility is important when it comes to using long volatility effectively.
Exactly. Think of it this way.
Okay.
You can only add so much dressing to a salad before it becomes soggy and unappetizing.
Right.
With long volatility.
Yeah.
If you overload a traditional portfolio, it can actually drag down your returns.
Okay.
The One River research suggests that for a typical salad portfolio,
Right.
the optimal allocation to long volatility is likely under 10%.
So a little sprinkle of long volatility goes
Yeah.
a long way in that scenario.
Exactly.
But what about the soup portfolio? How does it handle this spicy ingredient?
Now, a soup portfolio,
Yeah.
with its more integrated approach and potential use of leverage,
Okay.
can handle a much more generous helping of long volatility. The flavors blend together more seamlessly,
Right.
and you might even find that a bit more spice enhances the overall taste.
Okay, I'm liking this analogy more and more. But what does this mean in practical terms? How
Yeah.
much long vol are we talking about for a soup portfolio?
One River's research delved into this using something called efficient frontier analysis, which sounds complicated, but it basically means finding the sweet spot between risk and return.
Right.
And their findings were pretty remarkable.
Okay.
For a soup portfolio, the optimal allocation to long volatility could be as high as 40% in some cases.
Wow, 40%. That's a huge difference from the 10% we were talking about for a salad portfolio.
It is.
Yeah.
And it really highlights the potential of this more integrated approach.
Right.
By blending different ingredients, you can potentially create a portfolio that's more resilient to market shocks and still capable of generating strong returns.
This is making a lot of sense.
Good.
But I have to ask,
Sure.
what about those investors who are perfectly happy with their simple salad portfolios.
Yeah.
Why should they even consider adding this long volatility spice?
It's a valid point.
Yeah.
And for many investors, a straightforward, diversified portfolio might be perfectly sufficient.
Right.
But what if the market dynamics that we've become accustomed to start to shift?
What do you mean?
Think about it. We've been in a historically long bull market for equities.
Right.
But that won't last forever.
Right.
And when that tide turns, the traditional relationships between stocks and other assets, like bonds, could change dramatically. Diversification might not work the way we expect it to.
So the classic salad recipe might not be as effective in a different market environment.
Exactly. And that's where long volatility comes in.
Okay.
Even if you're not looking to completely overhaul your investment approach, having a small allocation to long volatility can act as a kind of hedge against those unexpected market shifts.
It's like having a backup plan just in case the salad starts to wilt.
I like that.
Okay.
And the research backs this up.
Okay.
Even during this incredible bull market, long volatility strategies have still managed to add value.
That's pretty impressive.
It is.
It's not just about protection.
Right.
It's about enhancing returns in any market environment.
Exactly.
But let's be realistic. Long volatility sounds complicated.
It can be.
How can the average investor even begin to incorporate this into their portfolio?
It definitely requires some research and understanding.
Right.
But there are resources available to help.
Okay.
One River Asset Management, for example, has a lot of information on their website about different long volatility strategies and how they work.
So listeners, don't be intimidated by the fancy terminology.
Right.
There's a wealth of information out there to help you get started.
There is.
And if you're working with a financial advisor, this is definitely something worth discussing with them.
Absolutely.
Okay.
A good advisor can help you determine if long volatility is right for you and how to implement it in a way that aligns with your overall goals and risk tolerance.
All right, so we've covered a lot of ground.
We have.
We've talked about the potential benefits of long volatility.
Right.
The different ways to rebalance your position.
Exactly.
And how the optimal amount you use can depend on your overall portfolio approach. Any final thoughts for our listeners as we move into the final part of this deep dive?
The key takeaway here is that long volatility isn't just for sophisticated investors or hedge fund managers.
Okay.
It's a tool that anyone can use to potentially enhance their portfolio's resilience and performance.
Right.
But it's important to do your research, understand the risks, and seek guidance if needed.
Okay. Sounds like a plan.
Yeah.
Now, before we wrap up, I have to ask.
Sure.
You mentioned that One River found some interesting results when they looked at the hybrid rebalancing approach.
Right.
Did they crack the code to maximizing returns?
Well, let's just say their findings add another layer of intrigue to this whole conversation.
Okay, you've piqued my curiosity.
Yeah.
What did One River discover about this hybrid approach to rebalancing?
Their research indicated that combining calendar and threshold rebalancing often led to the highest overall returns.
Okay.
It seems to capture the best of both worlds.
Right.
You get the discipline and consistency of the calendar approach.
Right.
But you also have the flexibility to capitalize on those big market swings when they occur.
So it's like having your cake and eating it too.
Exactly.
With a bit more nuance.
Exactly. But there's a catch, of course.
Okay.
This hybrid approach is also the most complex to manage.
Right.
It requires a deeper understanding of market dynamics.
Yeah.
And a willingness to actively monitor your portfolio and make adjustments as needed.
So it's not a set-it-and-forget-it strategy.
Right.
But it might be worth the extra effort for investors who are comfortable with that level of involvement.
Precisely.
Oh, yeah.
And it highlights a crucial point about long volatility.
Okay.
It's not a one-size-fits-all solution.
Right.
The optimal approach depends on your individual goals, risk tolerance, and investment style.
That makes a lot of sense.
Yeah.
It's like any good recipe.
Exactly.
You need to adjust the ingredients and the cooking method to suit your own taste and preferences.
I like that analogy. It speaks to the importance of understanding the underlying concepts rather than just blindly following a formula.
Right.
Whether you're a soup investor or a salad investor.
Yeah.
The key is to think critically about how long volatility fits into your overall portfolio strategy.
So as we wrap up this deep dive,
Sure.
what are some key takeaways our listeners should keep in mind?
First and foremost, long volatility isn't just about hedging against losses.
Okay.
It can potentially be a powerful tool for enhancing returns,
Right.
even in a strong bull market.
Right.
But it's crucial to understand the different ways to approach it.
Right, and that includes considering your own investment style
Exactly.
and how much risk you're comfortable taking on.
Yeah.
Are you looking for steady and consistent returns?
Right.
Or are you willing to embrace a bit more volatility in pursuit of potentially higher gains?
Those are great questions to consider.
Yeah.
And if you're feeling overwhelmed by all this information, don't hesitate to seek guidance from a financial professional.
Yeah, that's great advice.
They can help you navigate the complexities of long volatility and determine if it's right for you.
It's always better to ask for help than to go it alone, especially when it comes to something as important as your investments.
Absolutely.
Right.
And remember, knowledge is power.
Yes.
The more you understand about different investment strategies, the better equipped you'll be to make informed decisions and achieve your financial goals.
Well said. And I want to encourage our listeners to continue exploring these concepts even after today's deep dive.
Yeah.
There's a wealth of information out there,
Absolutely.
and we'll be sure to continue covering these topics in future episodes.
This is just the beginning of the conversation.
Yes.
The world of investing is constantly evolving, and there's always something new to learn.
Listeners, we hope you've enjoyed this exploration of long volatility and how it can be used to spice up your investment portfolio.
It's a good one.
Remember, the key is to find the right recipe for your individual circumstances and taste.
Exactly.
Until next time, happy investing.